Markets are officially open for trade. Joining me now to kick off the session is Brian Bendig. He's the Chief Investment Officer at MJP Wealth Advisors. Brian, welcome to the New York Stock Exchange.
Thank you, Ashley.
So what are you going to be following most closely in today's session?
Well, we've seen a couple choppy days in the market, with headline risk, concerns about policy, and also valuations with equities. And I think underneath the surface, if we see any flow through on any pressure on tech today, coming from uncertainty around Trump administration policies on software restrictions, I think is something to look out for. But really on an overall basis, we've seen pretty strong sales numbers and earnings numbers so far for Q3. And curious to see if we see a little bit of a broadening in the market with some of the more cyclical areas catching a bid.
That's right. We're back in earnings season again. What are your takeaways so far?
Well, I think going into earnings, it was one of the few times we actually saw analysts increase EPS numbers and profit outlook numbers, even though we had a backdrop of being at all-time highs in the market. So I think what investors are focusing on right now is that there is that expectation that earnings is going to be strong, but what are those outlooks saying for balance of the year when considering that we still haven't seen 100% certainty on the trade front? We're still getting some concerns on where we are with Fed policy and the labor market, and then is earnings going to be enough to justify these valuations?
All right, we are on day 23 of the government shutdown. I understand that you think there's an end in sight. Can you elaborate?
Well, I guess I'm naturally optimistic that eventually we're going to get to resolution, and it's not going to take as long as one senator might have said recently, where this might go out till Thanksgiving. I think we're starting to see some strategies coming in place on the Republican side as well as on the Democrat side, especially when considering that Trump is leaving the country for several days, when considering his economic visit to Asia. So our expectation is that when we get through the end of the month, that's another paycheck that's going to be missed by government workers. That pressure might start building on moderates, and then that's why our expectation is there could be some resolution in the first half of November.
And tomorrow, highly anticipated CPI data will be released, 8:30 a.m. What are you anticipating for that?
Well, I don't think the CPI number is necessarily going to really influence the Fed's decision on rate cuts, regardless of how hot inflation comes in. I think the Fed is focusing on growth, is focusing on the fact that the labor market is bending, not breaking, so we should expect a rate cut next week. But as it relates to CPI, we're seeing that about 60% of the inputs into that indicator are tracking at 3% or more. So we're expecting a month-over-month increase around 0.4% aligned with consensus estimate, and that we're probably going to see inflation being a little bit stickier in the services sector and persist with us in the balance of the year. But I think for 2026, demand is sensitive to price, and we agree with the Fed's view that inflation should dissipate over time when considering movements of the economy going into a little bit of a slower growth environment over the balance of 2026.
And the Fed is going to be making their next interest rate decision next Wednesday, next week. What do you think might happen?
Well, I mean, as I mentioned, I think the Fed has a really high probability that they're going to cut interest rates 25 basis points to support the economy in the short term, because we have the uncertainty around the government shutdown, and if that does lead a little longer than we expect, and it could lead to any permanent job layoffs, the Fed wants to be there to support the economy in the short term. Plus, they'll have a wait-and-see opportunity with more data coming in post-government shutdown getting resolved and getting more frequent data to their attention, which then can give them the optionality of what to do with rates in December. So I still think the Fed is moving in a direction of being more neutral on policy. We're expecting commentary to talk about the end of quantitative tightening, and I think that is something that's going to help to support the economy, especially small to medium business, over the next 3 to 6 months.
And what do you see, what's your outlook for 2026 for any further rate cuts, potentially?
Well, I think when you think about where inflation is right now, if we're kind of hanging around, a 3 handle on CPI headline, and if the 10-year Treasury continues to hover around 4%, if we have a cut or two this year, then I think in our mind it sets up for only about 1 to 2 interest rate cuts next year. The market's definitely pricing in more. So there could be some disappointment there that the Fed is not as accommodating as investors are hoping. But I think the next series of data points over the next couple of months will give us a little bit better clarity for 2026.
And given the market volatility and economic headwinds, how are you advising clients right now?
Well, I'm going to use the classic expression, Ashley, that it really makes sense to diversify. And what I mean by that on the equity side is that we know we've had a great run in AI innovative themes in the market, but you have to be sensitive to valuations and making sure that you're not overpaying for growth. And when we look at earnings outlooks for balance of the year into next year, we're seeing greater participation coming from healthcare, industrials, financials, deregulation in the financial space, tax incentive to invest in infrastructure and CapEx in the industrial space, and also just thinking that profit growth should expand for medium and smaller companies with a more accommodative regulatory as well as Federal Reserve interest rate backdrop. So I think we're thinking about all areas of the U.S. equity complex, also maintaining exposure for international equities, but at the end of the day, people are forgetting about bonds. Bonds are really attractive right now from a valuation point of view. And if we get that slowdown in the economy and a little bit lower inflation as time goes on, rates should come down naturally with the yield curve steepening in the short term, but then broadening out as over the next 15 months.
And I know they just saw a very steep sell-off, but what are your thoughts on gold and silver in our last 30 seconds?
Yeah, I mean, I definitely think that, going into this week, gold looked definitely and silver looked a little bit overbought. But I think at the same point in time, this correction is healthy. And I think some of the still macro concerns around geopolitical deficits in the U.S., some of the concerns on just, trying to maintain a little bit of a risk-off sentiment in a portfolio still makes sense. And I think the biggest move with gold is also paying attention to the price of the U.S. dollar. So dollar strengthening recently has also impacted the price, which I also think contributed a little bit to the sell-off this week.
All right, Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Thank you for joining us at the New York Stock Exchange.
Thank you, Ashley.